$300 billion frozen overnight. That's how much Russian central bank assets were locked by Western sanctions in March 2022. Not seized, not destroyed, just inaccessible. Like having your bank account frozen, except the bank account belongs to an entire country, and the amount is larger than the GDP of Finland. These weren't Bitcoin sitting in some wallet that could be moved with a password. These were government bonds, treasury securities, reserves held in dollars, euros, pounds, the safest assets in the world, according to every economics textbook written in the last 70 years. The foundation of international finance, the backbone of global trade. Except on March 2nd, 2022, they stopped being safe. They became leverage. This wasn't just the largest financial weapon ever deployed in human history. It was a fracture in the system itself, a signal that the rules everyone thought were permanent could change in a weekend. But systems don't abandon beliefs overnight. People do. And to understand why Russia built an entire cryptocurrency payments infrastructure in response to those sanctions, we need to understand what those frozen assets meant to the people who watched it happen in real time. To illustrate this, let me tell you a story. Obviously a fictional one, but bear with me, because it's built from documented events, real transactions, and verified policy developments that happened across hundreds of Russian companies. Picture this guy, Dmitry Volkov, 52 years old, CEO of a mid-sized Russian trading company that moves industrial equipment and raw materials between Russia, China, India, and the Middle East. Before that, he spent 18 years at Gazprom Bank, running international settlements. His job was simple: make sure payments cleared, dollars out, rubles in, euros to suppliers, yuan from customers. For nearly 2 decades, his entire career was built on one fundamental belief: the international banking system works. You send a SWIFT message, the money moves. You hold dollars in correspondent banks, they're accessible. You trust the infrastructure because everyone trusts the infrastructure. It's not exciting work. Nobody makes movies about trade finance officers, but it's essential. Without people like this, global commerce stops. Ships don't leave port, factories don't receive materials, supply chains collapse. The morning routine was mechanical. 7 a.m., log into banking portals, check overnight clearing, confirm that yesterday's invoices had settled, review today's outgoing wires. By 8 a.m., 15 to 20 transactions cleared, moving anywhere from $50,000 to $5 million depending on the contracts. Coffee at the desk, black, no sugar. Quick call with logistics about a delayed shipment from Novosibirsk. Another call with a Chinese counterparty about payment terms for a steel order. Lunch was usually something delivered while working through compliance documents. The system was boring, predictable, reliable, which is exactly what you want when you're moving hundreds of millions of dollars a year. Dmitry had no interest in cryptocurrency. Bitcoin was something he'd heard about, obviously. Some younger colleagues talked about it. He thought it was speculative nonsense, volatile, unregulated. Why would anyone use digital tokens when you had a perfectly functional system of correspondent banking, SWIFT networks, and dollar settlements that had worked flawlessly since the Bretton Woods era? He didn't need innovation. He needed reliability. Then February 24th, 2022 happened. Russia invaded Ukraine, and Dmitry's perfectly reliable system started cracking. First, it was small things. A payment to a German supplier took an extra day. A British bank requested additional documentation for a routine transfer. Normal friction, he thought. Geopolitical tensions always add paperwork. Then came the call that changed everything. Before we continue with Dmitry's story, do me a quick favor. Hit that subscribe button right now. This is going to be a deep dive into how Bitcoin went from internet money to geopolitical infrastructure, and you'll want to follow this channel for more content like this. And here's the thing. I want to know what you think about Bitcoin. Drop a comment right now, just one word. Bullish if you think Bitcoin becomes a global reserve asset, or bearish if you think this whole thing collapses. I'm genuinely curious what this audience thinks. Comment bullish or bearish right now before we get back to Dmitry's story. All right, back to March 2022. Dmitry was reviewing contracts when his phone rang. It was the CFO. Turn on the news. He pulled up Reuters on his second monitor. The headline was simple but devastating. Western allies freeze Russian central bank assets. $300 billion, gone, not seized, not stolen, just locked, inaccessible. This is documented fact. Confirmed by Reuters, the European Union, the US Treasury, the largest asset freeze in financial history. Dmitry's first thought wasn't about the central bank. It was about his company's dollar accounts. He opened the banking portal. The balance showed normally. Money they needed to pay suppliers in China next week. Money that technically was still there, but was it accessible? He tried to initiate a test transfer. Transaction pending review. He called the bank. 45 minutes on hold. When someone finally answered, the message was corporate. And careful. We are reviewing all Russian counterparty relationships in light of recent sanctions developments. Translation. Your money is frozen, not officially, not legally, just frozen. Over the next 72 hours, Dmitry watched his entire payment infrastructure disintegrate. This is verified. SWIFT access for major Russian banks was cut, not suspended, severed. You can verify this through Reuters reports from March 2022. Correspondent banking relationships that had existed for decades were terminated with 48 hours notice. European banks stopped processing ruble transactions entirely. Chinese suppliers were calling, "Where's the payment? The shipment is ready." Dmitry's company owed $12 million in payments due within 2 weeks. He had the money. It just existed in a banking system that would no longer move it. The emergency meetings started immediately. Every trading company in Russia was facing the same crisis. This isn't speculation. Reuters documented this extensively. Billions in frozen assets, thousands of contracts in limbo, no way to pay suppliers, no way to receive payment from customers. Someone suggested using Chinese banks exclusively, but even Chinese banks were cautious. The secondary sanctions risk was too high. If they processed too many Russian transactions, they could lose their own dollar clearing access. Someone else suggested barter arrangements, trade oil for equipment, raw materials for manufactured goods, like it was 1945. Dmitry sat in these meetings thinking, this is insane. We have a 21st century global economy, and we're discussing barter because the payment rails are political weapons now. That's when one of the younger analysts said something that made the entire room go quiet. What about cryptocurrency? The older executives laughed. Dmitry didn't laugh, but he was skeptical. Bitcoin? For industrial payments? It was absurd. But the analyst pulled up data. Russia's been studying this for 2 years. The central bank has a working group. There's draft legislation. This isn't theoretical anymore. Dmitry asked the obvious question. How would it even work? The analyst explained. We convert rubles to crypto, send it to the Chinese buyer. They convert crypto to yuan. No bank involved, no SWIFT required, no sanctions risk. It sounded ridiculous. But Dmitry was about to discover it was the only thing that worked. Let me show you exactly what broke. For 30 years, Dmitry had executed the same basic strategy. Use the dollar as the settlement layer for international trade. Doesn't matter if you're a Russian selling to China or Chinese selling to Russia. You clear in dollars. Why? Because dollars are liquid, stable, and universally accepted. Here's how a typical transaction worked. Russian company wants to buy equipment from China worth $1 million. Dmitry's company sends a SWIFT message to their correspondent bank in Frankfurt. Frankfurt sends dollars to Chinese company's correspondent bank in Hong Kong. Hong Kong converts dollars to yuan. Chinese company receives yuan. Equipment ships. The whole process took 3 days. Fees were minimal, maybe 0.1%. $10,000 in friction to move $1 million. Totally acceptable. This system worked because of 2 assumptions. 1, the banking system is apolitical. Your access to correspondent banks doesn't depend on your government's foreign policy. 2, reserve assets are sacred. If you hold dollars or euros in reserve, they're safe regardless of what your government does. Both assumptions died in March 2022. Dmitry watched this happen in real time, transaction by transaction. First, the SWIFT cutoff. Russia's largest banks were removed from the network, not suspended, expelled. This is documented. You can verify this through Reuters reports from March 2022, which meant even if you had dollars, you couldn't send a SWIFT message to move them. It's like having a debit card, but no ATM that accepts it. Second, correspondent banking collapse. Western banks terminated relationships with Russian institutions. Your dollars might exist on a balance sheet somewhere, but good luck accessing them. The rails were cut. Third, and this was the part that kept Dmitry awake at night. The $300 billion freeze proved that reserve assets aren't actually safe. They're only safe until they become geopolitical leverage. Russia had spent decades accumulating those reserves precisely as insurance against sanctions. Held them in dollars, euros, yen, the safest, most liquid assets in the world. And in one weekend, they became unusable. Dmitry had a conversation with a colleague in Singapore a week after the freeze. The guy worked at a sovereign wealth fund, Asian country, neutral in the Ukraine conflict. Dmitry asked him, "Are you worried about dollar reserves?" Long silence. Then, "Everyone's worried. If they did it to Russia, they can do it to anyone." This was the crack in the foundation that nobody wanted to acknowledge publicly. But local currency settlement is slow, complicated, and limited to countries that agree to it. And then the Federal Assembly fast-tracked a bill that nobody expected, allowing cryptocurrency for international payments. It passed in July 2024. Putin signed it in August. This is documented fact. You can verify this through CNBC, Reuters, and CoinDesk reports from summer 2024. Suddenly, Bitcoin wasn't just speculative internet money. It was legally sanctioned infrastructure for international trade. Dmitry read the legislation carefully. The framework was specific. Companies could use cryptocurrency to settle cross-border transactions. Exchanges would be regulated but permitted. Mining would be legal in designated zones. The central bank would oversee compliance but wouldn't block transactions. He called the analyst who'd suggested crypto months earlier. Is this real? Can we actually do this? We're already doing it. The oil companies have been running pilot programs since April, tens of millions of dollars per month. That's a direct quote from Reuters reporting in March 2025 about Russian oil companies using crypto. Dmitry asked for specifics. Here's what he learned. And this is documented by Reuters. Russian oil companies were selling crude to China and India, hundreds of millions of dollars in monthly volume, but they couldn't receive dollars directly, so they structured deals like this. Chinese buyer pays in yuan to a Russian account in China. Russian company converts yuan to Tether, a stablecoin pegged to the dollar. Tether moves via blockchain to a wallet controlled by a middleman. Middleman converts Tether to rubles in Moscow. Russian company receives rubles. The whole process took hours instead of days. Fees were higher, maybe 0.5% instead of 0.1%, but it worked. No correspondent bank required, no SWIFT message needed, no sanctions risk because the transaction never touched the Western banking system. Dmitry ran the numbers on a sample transaction. $1 million in equipment from China. Traditional route, frozen, impossible. Crypto route, convert rubles to USDT at Moscow exchange, send USDT to Chinese counterparty. They convert USDT to yuan. Total time, hours, total fees, significantly higher but manageable. It wasn't elegant, but it was functional. And in a world where the elegant system had just weaponized itself, functional was enough. Dmitry made a decision that would have been unthinkable 6 months earlier. He was going to use Bitcoin for international payments. The first transaction was terrifying. It was August 2024. Dmitry's company owed a Chinese manufacturer $800,000 for a shipment of industrial pumps. The equipment was sitting in a warehouse in Shenzhen. The Chinese company wouldn't release it without payment. Traditional banking, impossible. SWIFT, cut off. Correspondent accounts, frozen. Only option, cryptocurrency. Dmitry sat in a conference room with his CFO, legal counsel, and the young analyst who'd become their de facto crypto advisor. They were staring at a laptop screen showing a cryptocurrency exchange interface. His CFO was nervous. We're really doing this? Moving almost $1 million through Bitcoin? Dmitry nodded. Unless you have a better idea. Nobody did. Here's how the transaction actually worked. And this process is documented in multiple Reuters reports and Chainalysis. Step 1. Convert rubles to USDT. They used a Moscow-based exchange that had just received regulatory approval under the new law. The exchange rate included a premium of around 3% because of liquidity constraints. Step 2. Transfer USDT to a middleman wallet. This was the sketchy part. The middleman was a Dubai-based trading company that specialized in crypto to fiat conversion for Russian and Chinese counterparties. Dmitry didn't love trusting a third party, but the Chinese manufacturer wouldn't accept crypto directly. They needed yuan. Step 3. Middleman converts USDT to yuan and deposits to Chinese manufacturer's bank account. This took 8 hours. Dmitry spent those 8 hours refreshing blockchain explorers, watching the transaction confirmations, feeling his blood pressure spike every time the page loaded. Step 4. Chinese manufacturer confirms receipt of yuan, releases the equipment, total time, 12 hours. Total cost in fees and conversion losses, around 5%. Compare that to 0.1% in the traditional system. But it worked. The equipment shipped, the contract was fulfilled, his company stayed operational. Over the next 6 months, Dmitry processed 212 transactions using cryptocurrency. Total volume, $87 million. He used Bitcoin for some deals, Tether for others, occasionally Ethereum when counterparties requested it. Every single transaction felt precarious. He was dealing with unregulated middlemen in Dubai and Hong Kong. Exchange rates fluctuated wildly. Blockchain confirmations sometimes took hours during network congestion. One transaction got stuck for 14 hours because he used too low a transaction fee and had to learn about replace by fees mechanisms on the fly. But here's what he learned. It worked when nothing else did. His competitors who refused to adapt, many went bankrupt, couldn't pay suppliers, couldn't receive payment from customers. Supply chains collapsed. The companies that survived were the ones willing to use crypto. And it wasn't just small trading firms. The big players were doing this at massive scale. According to Chainalysis reports, by fiscal year 2024, Russia had processed approximately $15 billion in cryptocurrency transaction volume for international trade. That's documented, verified. Dmitry heard through industry contacts that Russia's oil trade with China and India, worth roughly $192 billion annually according to International Energy Agency data, was increasingly settling through cryptocurrency. Reuters documented in March 2025 that Russian oil firms were using Bitcoin, Ethereum, and Tether for cross-border payments. The Russian finance minister, Anton Siluanov, confirmed it publicly in December 2024. He didn't provide exact numbers, but he acknowledged that Bitcoin was being used for international payments. That was the moment Dmitry realized this wasn't temporary. This was the new system. He had a conversation with an executive from Gazprom Neft in January 2025. The guy was frank. We're moving tens of millions of dollars per month through crypto. We have dedicated teams managing wallets. We've trained our finance staff on blockchain operations. This isn't experimental anymore. This is infrastructure. That's consistent with what Reuters reported about Russian energy companies. Dmitry asked, "What happens when sanctions end? Do we go back to dollars?" The Gazprom executive laughed. "What makes you think we'd want to? We just learned that dollar reserves can be frozen, SWIFT access can be revoked, correspondent banking can disappear overnight. Why would we ever fully trust that system again?" That conversation stayed with Dmitry because it wasn't just about Russia anymore. If Russia was forced to build crypto infrastructure to bypass sanctions, and that infrastructure actually worked, then other countries would notice, especially countries that might face sanctions someday, or countries that just wanted alternatives to dollar dependence. The game theory was obvious. Once one country builds functional crypto payment rails, others have an incentive to build them too. Which means Bitcoin wasn't just helping Russia bypass sanctions. It was becoming the foundation for a parallel international payment system. Dmitry looked at his transaction records from the past year. 212 crypto transactions, $87 million. 0 failures once he learned the system. Compare that to his experience with traditional banking since March 2022. Hundreds of frozen transactions, billions in inaccessible assets across the Russian financial system. Complete breakdown of international payment infrastructure. The system that was supposed to be reliable had failed catastrophically. The system that was supposed to be speculative internet money had kept his company alive. And then came the announcement that changed everything. March 2025. Dmitry was invited to a Ministry of Finance briefing in Moscow. Invitation only. About 60 people in the room. CEOs of major trading companies, representatives from energy firms, a few banking executives, and several government officials. These types of meetings actually happen. We know from multiple sources that Russia has been conducting high-level policy discussions about cryptocurrency integration. The presentation was titled, "Strategic Framework for Cryptocurrency Integration in International Trade." Dmitry took a seat near the back. He expected a boring policy update. What he got was a blueprint for rebuilding Russia's entire international payments architecture. The first slide showed a number, $300 billion. The frozen reserves, still frozen, probably permanently. The presenter, a deputy minister Dmitry recognized from television, spoke plainly, "We're not getting this money back, not in our lifetimes," which means we need to accept a fundamental truth. Reserve assets denominated in Western currencies are not safe for countries that might conflict with Western interests. No euphemisms, no diplomatic language, just facts. Next slide, SWIFT transaction volume, Russian banks. A graph showing transaction volume collapsing from March 2022 onward, down 93%. We've been cut off from the primary international payments network. This isn't temporary. This is the new reality. Dmitry watched executives around the room shifting in their seats. Everyone knew this, but hearing it stated so bluntly was different. Next slide, current alternative payment mechanisms, bilateral currency swaps with China, barter arrangements with India, gold transfers for some transactions, and in bold text, cryptocurrency settlement, $15 billion in volume, fiscal year 2024. 15 billion? That number comes from Chainalysis reporting. It's documented, verified. Dmitry had processed 87 million himself. He'd thought his company was an edge case. Turns out, crypto settlement had scaled to 15 billion across the entire economy. The deputy minister continued, "These aren't pilot programs anymore. This is infrastructure, and we're expanding it." Next slide. Legal framework enhancements. New legislation in development to authorize central bank oversight of cryptocurrency exchanges, create regulatory standards for crypto custody, allow pension funds and sovereign wealth funds to explore digital assets, and establish Bitcoin and Ethereum as acceptable settlement instruments in commercial contracts. That last point made Dmitry sit up. If Bitcoin was recognized as a legal settlement instrument in contracts, it meant you could sign a deal specifying payment in Bitcoin and have it enforceable in Russian courts. That wasn't theoretical anymore. That was treating cryptocurrency like any other currency. But the next slide was the one that made the entire room go silent. Strategic reserve considerations. The deputy minister paused before speaking. "We've lost access to $300 billion in dollar and euro reserves. We cannot allow this to happen again, which means we need reserves that cannot be frozen by foreign governments." He clicked to the next slide. It showed a simple comparison table. U.S. Treasury bonds, held in U.S. banks, can be frozen. Require SWIFT for transactions. Access can be revoked. Value denominated in dollars, subject to U.S. monetary policy. Legal jurisdiction, U.S. courts. Gold, physical storage, can be seized. Transportation difficult and expensive. Digital transfer impossible. Bitcoin, held in cryptographic wallets, cannot be frozen without private keys. Transferred via blockchain, no intermediary required. Value determined by market, no central bank control. Legal jurisdiction, no single authority. Dmitry read through the list twice. It was technically accurate, but seeing it laid out like this, as a serious policy comparison, was jarring. The deputy minister continued, "We're not suggesting replacing all reserves with Bitcoin, but we are suggesting that a portion of national reserves should be held in assets that cannot be weaponized against us." Someone in the front row, Dmitry recognized him as an executive from Rosneft, asked the question everyone was thinking. "What percentage?" The deputy minister smiled slightly. "That's above my authority to disclose, but I can tell you that the ministry has been studying models ranging from various allocation scenarios." The presentation continued with technical details, custody solutions, multi-signature wallet architecture, regulatory compliance frameworks, insurance mechanisms for exchange counterparty risk. But Dmitry was thinking about the implications. Russia wasn't just trying to survive sanctions. They were trying to build an alternative system that other countries might want to join. The deputy minister wrapped up with a final slide. Strategic objectives. 3 bullet points. 1. Eliminate single point of failure risk in reserve management. 2. Build sanctions-resistant payment infrastructure. 3. Position Russia as a leader in post-dollar international finance. That third point was ambitious. Russia wasn't trying to just survive. They were trying to build infrastructure for a different financial architecture. After the presentation, Dmitry talked with other attendees. The consensus was uniform. This was happening. The government was committed. The legal framework was being built. The infrastructure was already operational at scale. One executive from a shipping company told Dmitry, "We are processing 30% of our international payments through crypto now. Next year, we're targeting 50%. Dmitry asked, "What about volatility? Bitcoin dropped 40% last year." The guy shrugged. "So did the ruble. And unlike rubles, I can send Bitcoin to Shanghai in 6 hours without asking permission from a Western bank." That was the calculation. Not whether Bitcoin was perfect, whether it was better than a system that had been weaponized. Dmitry left that briefing with a clear understanding. Russia had made a strategic decision to embrace cryptocurrency, not despite the sanctions, but because of them. The West had frozen $300 billion, thinking it would cripple Russia's economy. Instead, it had forced Russia to build infrastructure that didn't depend on Western financial systems. And that infrastructure was powered by Bitcoin. And this wasn't just Dmitry's story anymore. According to public statements from Russian officials, including Finance Minister Anton Siluanov, in December 2024, Russia confirmed it was using Bitcoin for international payments. Over the next 3 months, Dmitry became obsessed, not with Bitcoin's price, with the system logic. He'd spent his entire career in a financial architecture built on one assumption. The dollar system was permanent, neutral, and reliable. Now that assumption was proven false, which meant he needed to understand what came next. He started studying reports, not crypto influencer content. Serious institutional research, Chainalysis reports on sanctions evasion, central bank white papers on digital currencies, academic papers on game theory and international payments, late nights, weekends. His wife thought he was having a midlife crisis. Maybe he was, but the crisis wasn't personal. It was systemic. First thing that convinced him, the dollar system's dependency on trust. For 70 years, the dollar worked as the global reserve currency because everyone trusted 3 things. 1, the US wouldn't inflate it to worthlessness. 2, the US wouldn't freeze your reserves for political reasons. 3, the banking system would remain accessible to everyone. March 2022 broke assumption 2. The $300 billion freeze proved that dollar reserves are only safe until they're leverage. Once you're in geopolitical conflict with the US, your reserves are hostage. Dmitry had experienced this personally. His company's accounts? Frozen. Not because his company violated any law, because his government invaded Ukraine. Collective punishment through financial infrastructure. And here's what made Dmitry's stomach turn. If it happened to Russia, it could happen to anyone. China watching this, India watching this, Saudi Arabia watching this. Every country that might someday conflict with Western interests now knows your dollar reserves are conditional. Second thing that convinced him, duration risk in bonds. Russia had held most of its reserves in government bonds, US treasuries, German bunds. Safe, stable, interest-bearing. But bonds have duration risk. If interest rates rise, bond prices fall. Russia's frozen reserves included bonds purchased when yields were near zero. Now yields were at 5%. Those bonds had taken massive losses. Losses Russia couldn't even realize because the assets were frozen. Dmitry remembered the night he calculated it, sitting at his kitchen table with a spreadsheet. If Russia's $300 billion in frozen reserves included substantial bond holdings with significant duration, and yields had risen from 1% to 5%, the losses could be enormous, 20%, maybe more. Not from the freeze itself, from being locked into positions while the market moved against them. He thought, what if those reserves had been in Bitcoin instead? Bitcoin has no duration risk, no coupon payments, no maturity date. It's just an asset that either goes up or down based on supply and demand. High volatility, yes, but no structural exposure to interest rate changes. And more importantly, Bitcoin can't be frozen if you control the keys. Third argument, inflation protection. The ruble had collapsed after sanctions. Dmitry watched the exchange rate go from 70 rubles per dollar to 120 at its worst. His company's ruble-denominated assets had lost 40% of their dollar value in 6 months. Russian citizens panicked. Russian banks, conversion to dollars, euros, anything stable, except dollars and euros were unavailable because of sanctions. Some people bought gold, premiums spiked to 20% above spot price, and you still had to store it physically, worry about authenticity, pay for security. Some people bought Bitcoin. Dmitry watched Bitcoin's adoption curve in Russia accelerate dramatically. Trading volume on Russian exchanges hit all-time highs. Peer-to-peer Bitcoin transactions surged. Not speculation, flight to assets that couldn't be frozen or devalued by domestic policy. Fourth, geopolitical neutrality. This was the argument that finally broke through Dmitry's skepticism. Gold is neutral in theory, but in practice it's tied to physical jurisdiction. Russia's gold reserves were stored in vaults that could be sanctioned, restricted, or even seized if Russia transported them through certain jurisdictions. Dollars are explicitly not neutral. They're the currency of the United States. Holding dollars means trusting the US to maintain access. Russia learned that trust was misplaced. Bitcoin is mathematically neutral. It doesn't care about your nationality, your politics, or your government's foreign policy. If you have the private keys, you control the Bitcoin. No intermediary can freeze it. No government can seize it without the keys. Dmitry found himself explaining this to colleagues using an analogy. Dollars are like renting storage space in a building owned by someone else. They can lock you out anytime. Bitcoin is like having the only key to your own safe deposit box. Someone asked, what if the price crashes? Dmitry's answer, what if dollar reserves get frozen? We already know that happened. Price crashing is a risk. But counterparty risk, the risk that someone blocks your access, that's been proven fatal. Fifth, settlement speed. This was operational, not philosophical, but it mattered. Traditional wire transfer from Moscow to Shanghai, 3 days. Bitcoin transaction, 6 hours at most, usually faster. For trade finance, speed is liquidity. 3 days of settlement time means 3 days of capital locked up. 3 days of exchange rate risk, 3 days of counterparty risk. 6 hours means you can turn capital faster, do more transactions with the same balance sheet, reduce operational risk. Dmitry had experienced this benefit directly. His crypto transactions settled same day. His traditional banking transactions, when they worked at all, took days. But the sixth argument was the one that made everything click. Game theory. Dmitry read a paper by a game theorist analyzing reserve asset competition. The conclusion was simple but profound. Once one country starts accumulating Bitcoin as a reserve asset, other countries face a prisoner's dilemma. If Bitcoin succeeds as a reserve asset, early adopters gain advantage. Late adopters pay higher prices. Non-adopters lose relative position. If Bitcoin fails, early adopters take losses. But if you're already sanctioned and excluded from dollar systems, what's the downside? Russia's position was unique. They'd already lost access to $300 billion in dollar reserves. They had nothing to lose by experimenting with alternatives. And if those alternatives worked, they'd have built infrastructure independent of Western control. Other countries watching this face a choice: ignore Bitcoin and hope dollar system remains accessible, or hedge by building crypto infrastructure in case they face sanctions too. Dmitry had a conversation with a contact in Abu Dhabi. The guy worked at a sovereign wealth fund. Dmitry asked him, is UAE looking at Bitcoin for reserves? The response was careful. We're evaluating all asset classes with reduced counterparty risk. Translation: yes. Dmitry realized the cascade was already starting. Russia was forced into Bitcoin by sanctions. But once Russia demonstrated it worked for international payments, other countries would adopt it voluntarily. Not because they loved Bitcoin, because they feared becoming the next Russia. The math was inevitable. The game theory was clear. And Dmitry, sitting in his office in Moscow, looking at his company's transaction history, $87 million moved via cryptocurrency over 18 months, understood something profound. His company's survival strategy was about to become every country's strategic priority. April 2025. Dmitry was invited to a closed-door session with ministry officials. 8 people in a conference room. No phones allowed, no recordings. The question was direct. Based on your operational experience with cryptocurrency payments, should Russia formally adopt Bitcoin as a strategic reserve asset? Dmitry wasn't expecting that level of candor. The official clarified, you've moved $87 million through crypto infrastructure. You've trained your staff. You've built relationships with exchanges and middlemen. You've dealt with every operational problem, wallet security, transaction fees, price volatility, counterparty risk. We want to know, does it actually work at scale? Dmitry thought carefully before answering. He'd spent 18 months using crypto out of necessity. His initial reaction had been skepticism. This was supposed to be speculative internet money. Volatile, unproven, risky. But the alternative was worse. He pulled out a printed report he'd prepared. Transaction data from his company. 212 transactions. $87 million in volume. 0 failures. Average settlement time, 6.2 hours. Average cost, 4.7%, including conversion fees and spread. He paused. Compare that to our traditional banking. Hundreds of attempted transactions. 0 successful completions. Average settlement time, infinite, because they never clear. The official nodded. We know the system works operationally. The question is strategic. Should we hold Bitcoin as a reserve asset? Not just use it for payments, but actually accumulate it as national reserves? This was the moment Dmitry had been thinking about for months. He looked around the room. These were people who'd spent careers managing reserves in dollars, euros, yen, the safest, most liquid assets in the world. Assets their textbooks said were risk-free, but those textbooks were written before $300 billion got frozen overnight. Dmitry spoke carefully. I spent 18 years at Gazprom Bank, believing the international financial system was apolitical, that reserves were sacred, that swift access was guaranteed. I was wrong about all of it, he continued. The system worked as long as Russia's interests aligned with Western interests. The moment they diverged, the system became a weapon. Our reserves became hostages. Our banking access became leverage. One of the officials interjected, but Bitcoin is volatile. It dropped 40% last year. Dmitry nodded. It did, and the ruble dropped 40% after sanctions. And our frozen bond holdings lost 20% to duration risk. And we lost complete access to $300 billion regardless of its paper value. He leaned forward. The question isn't whether Bitcoin is volatile. The question is whether Bitcoin can be frozen by foreign governments. And the answer is no, not if we control the keys. Another official. What about operational risk, wallet security, exchange hacks? Dmitry had dealt with this personally. It's real risk, but it's manageable risk. Multi-signature wallets, cold storage for long-term holdings, regulatory oversight of exchanges. The technology exists. We just need to implement it with state-level security protocols. Silence in the room. The senior official asked the final question. If you were making this decision for your own company, not for Russia, but for your company's reserves, would you hold Bitcoin? Dmitry thought about his own personal position. He'd been paid in rubles his entire career, rubles that had collapsed in value. He'd kept some savings in dollar accounts, accounts that got frozen. 3 months ago, he'd bought Bitcoin. Not a lot. About 1 Bitcoin. He didn't do it for speculation. He did it because it was the only asset he was absolutely certain couldn't be frozen. Yes, he said. I would. I already do. The official smiled slightly. So does half this room. That admission hung in the air. These weren't crypto enthusiasts. These were government financial officers. Conservative, risk-averse, trained to hold bonds and currencies, and they were buying Bitcoin. The official concluded, we're moving forward with a strategic reserve allocation. We're exploring various models. Your operational experience will inform the implementation. Dmitry nodded. He understood what was happening. Russia wasn't just adopting Bitcoin because it believed in the technology. Russia was adopting Bitcoin because the alternative, continued dependence on a financial system that had weaponized itself, was strategically untenable. The decision wasn't made in March, when the reserves were frozen. It was made over 18 months, as people like Dmitry proved the alternative actually worked. And that decision, which became public when Finance Minister Anton Siluanov confirmed in December 2024 that Russia was using Bitcoin for international payments, was about to set off a chain reaction nobody could stop. Dmitry watched the cascade unfold in real time. May 2025, Russian Ministry of Finance announced a digital asset reserves framework. They didn't explicitly say Bitcoin, but the legislation specified decentralized cryptographic assets with fixed supply. Everyone knew what that meant. June, trading volume on Russian cryptocurrency exchanges hit $50 billion monthly. Not speculation, Institutional accumulation, energy companies, trading firms, sovereign wealth fund activity. Bitcoin's price started moving. 54,000 in April, 62,000 in June, 70,000 by July. Dmitry received calls from contacts across Asia and the Middle East, everyone asking the same questions. Is Russia really doing this? How's it working? What's the operational reality? He was honest. It's working, not perfect, but functional. And more importantly, it's the only thing that works when traditional systems cut you off. A contact from Kazakhstan called in June. We're seeing what Russia built. Our government is interested. Can you consult? Dmitry wasn't a consultant. He was a CEO trying to keep his company operational, but he understood the strategic context. Kazakhstan was watching Russia use crypto successfully. They shared a border with both Russia and China. They needed payment infrastructure that didn't depend on Western approval. By July, 3 Central Asian republics had passed legislation similar to Russia's, allowing cryptocurrency for international trade, regulating exchanges, building infrastructure. August. A report from Chainalysis documented Russian cryptocurrency usage had reached significant transaction volumes for the first half of 2025. The infrastructure was scaling. September, Anton Siluanov gave an interview to a Russian news outlet. He confirmed what everyone already knew. Russia has begun incorporating Bitcoin into strategic financial planning. He didn't give exact numbers, but the signal was clear. This was official policy now. October. The first spillover effect hit India. India had been Russia's largest oil customer after sanctions. They'd been paying in rupees through a complex clearing mechanism, but the system was slow, expensive, and limited. The People's Bank of China released guidance allowing state-owned enterprises to hold strategic technology assets, including distributed ledger protocols. Western analysts initially missed the significance. They thought it was about blockchain technology. Dmitry knew better. Strategic technology assets was code for Bitcoin. China was preparing legal ground for state-owned companies to hold crypto. Why? Because China had $2 trillion in U.S. Treasury holdings, and they'd watched Russia lose $300 billion to a freeze. The game theory was obvious. Diversify away from assets that can be weaponized. December. A sovereign wealth fund from the Middle East, Dmitry never learned which one, but he heard through contacts, allegedly acquired a substantial position in Bitcoin through over-the-counter desks in Switzerland. Rumored size, billions of dollars. January 2026. Bitcoin hit $100,000. Middle Eastern wealth funds accumulating because everyone else is accumulating. Each addition to the cascade made the next addition more rational. That's the game theory in action. February. The European Union announced its 19th sanctions package against Russia. It included specific targeting of cryptocurrency service providers facilitating Russian sanctions evasion. But here's what made Dmitry smile slightly. The sanctions were ineffective. You can't sanction a decentralized network. You can sanction exchanges, sure, but peer-to-peer transactions? Transactions through non-EU exchanges? Transactions settled in Dubai, Hong Kong, Singapore? The EU was using 20th century tools against 21st century infrastructure. March 2026. Dmitry attended an energy conference in Dubai, the unofficial topic of every conversation. Cryptocurrency infrastructure, Russian executives comparing notes with Chinese counterparts, Indian refineries discussing stablecoin settlement with Middle Eastern suppliers. Everyone building the same parallel system. One executive from a Chinese state-owned enterprise pulled Dmitry aside. The guy was frank. We've been watching what Russia built. It works. We're building the same thing. Not because we love Bitcoin, because we can't trust dollar infrastructure anymore. Dmitry asked, "What's your timeline?" Operational in 6 months, full integration within 18. That was the moment Dmitry understood the endgame. This wasn't just Russia evading sanctions. This was the emergence of a parallel international payments system built on cryptocurrency, used initially by countries under sanctions, then adopted by countries that fear sanctions, then adopted by neutral countries that want optionality, eventually used by everyone because of the network effects become undeniable. Dmitry thought back to March 2022, sitting in his office, panicking about frozen payments, thinking cryptocurrency was absurd. And now that infrastructure was spreading. April 2026. Dmitry received an unusual email. It was from a contact he hadn't spoken with in years, American, senior executive at a major U.S. bank. They'd worked together on correspondent banking arrangements back when Dmitry was at Gazprom Bank. The subject line, unofficial inquiry. The email was careful, professional, but the subtext was clear. Dmitry, hope you're well. I'm reaching out in a personal capacity, not representing my institution. We're seeing reports about Russian cryptocurrency adoption for international payments, trying to understand operational reality versus media narrative. Would you be willing to discuss? Confidential, of course. Dmitry stared at the email for 10 minutes. The U.S. banking system had frozen his company's accounts, cut off SWIFT access, severed correspondent relationships. And now they wanted to understand how Russia had built an alternative? He called the guy. The American was direct. We're hearing things. Large-scale crypto adoption, oil companies using Bitcoin for settlements, sovereign reserve accumulation. Is it real or hype? Dmitry laughed. It's real. We've moved over $200 million through crypto in the last 4 years. Energy companies are doing billions. It's operational infrastructure now, not experiments. Silence on the line. Then, how's it working? Operationally, I mean. Transaction failures, security issues, liquidity constraints. Dmitry explained the mechanics, exchanges, middlemen, multi-signature wallets, conversion processes, settlement times, costs. The American listened without interrupting. Finally, you know what's crazy? We're studying the same thing. Dmitry wasn't surprised. Why? Because we're watching China, India, Middle East. Everyone's building crypto payment infrastructure. And we're realizing the dollar system's dominance requires participants to voluntarily use it. If they build alternatives, we lose the advantage. The admission was stunning. This was a senior executive at a U.S. bank acknowledging that dollar hegemony was under threat, not from military rivals, from mathematical protocols. Dmitry asked, "What's the U.S. position on Bitcoin reserves?" The American was careful. Officially, no position yet. Treasury is cautious, SEC is regulatory focused. But quietly, there's serious discussion. Senator Lummis has been pushing a strategic Bitcoin reserve bill. Some people think it's crazy, but some people are running the numbers and realizing if other countries are accumulating, we need to consider our position or risk relative devaluation. Game theory, Dmitry said. Exactly. Prisoner's dilemma. If Russia, China, and the Gulf states are accumulating Bitcoin and we're not, we lose relative position. But if we accumulate, we validate their strategy. We're stuck. Dmitry smiled. We were stuck too. Then you froze our reserves. That solved the dilemma for us. The American sighed. Yeah, that's becoming clear. The freeze was effective short term, but long term it forced you to build infrastructure we can't control. And now everyone else is copying that infrastructure. They talked for an hour. The American asked detailed questions about operational challenges, regulatory frameworks, adoption curves. Dmitry was honest. He didn't sugarcoat the difficulties, high fees, volatility, complexity, but he emphasized the core advantage: no counterparty risk, no access control, no political weaponization. Before hanging up, the American said something that stuck with Dmitry. You know what's ironic? Bitcoin was invented by some anonymous person or group trying to create an alternative to central banks. Most people thought it was libertarian fantasy, but it took nation states to prove it actually works at scale. Russia didn't adopt Bitcoin because you love decentralization. You adopted it because we forced you to. Dmitry couldn't disagree. Over the next month, Dmitry had similar conversations with contacts in Japan, South Korea, Singapore, and Switzerland. Everyone asking the same questions. How does it work? What are the costs? What are the risks? Is it really scalable? And everyone reaching the same conclusion. It works. Not perfectly, but functionally. And more importantly, it works when traditional systems fail. A Japanese Ministry of Finance official told Dmitry during a video call, "We're watching what Russia built. We haven't faced sanctions, but we've seen treasury volatility destroy our reserves value. We're exploring alternatives." A South Korean central banker, "We can't ignore this anymore. If crypto becomes standard infrastructure in Asia, we need operational capability." A Swiss banker, "Neutral countries need neutral payment rails. Bitcoin might be the most neutral infrastructure available." The pattern was clear. Russia had been forced to build crypto infrastructure by necessity. Everyone else was building it by choice, but the result was the same. A parallel financial system emerging that didn't depend on Western banks, SWIFT, or dollar dominance. Dmitry realized something profound. The West thought sanctions were a weapon, but sanctions had created something more dangerous to dollar hegemony than any military threat. Sanctions had created an incentive for half the world to build infrastructure the West couldn't control, and Bitcoin was the foundation of that infrastructure. May 2026. Dmitry was preparing to retire. Not completely. He'd stay on as chairman of his company. But the day-to-day operations, the transaction management, the exchange relationships, the wallet security protocols, he was handing that to his successor. Her name was Alina, 34 years old. She'd joined his company in 2023, right when crypto adoption was accelerating. She'd never known the old system. She'd never processed a SWIFT transaction. Her entire career in international trade finance had been built on cryptocurrency infrastructure, which made her better suited for the next decade than Dmitry could ever be. They sat in his office for a handoff meeting. Dmitry walked her through the company's position. We're currently managing relationships with 8 cryptocurrency exchanges, maintaining hot wallets for operational liquidity and cold storage for long-term holdings, processing about 40 transactions per month, average volume $6.2 million monthly. Alina nodded. She already knew the numbers. She'd been managing operations for 2 years. Dmitry continued. When I started this company, international payments were simple. Swift message, 3 days, done. I never imagined I'd spend the last 4 years of my career learning about blockchain confirmations and multi-signature schemes. Alina smiled. When I started my career, I assumed cryptocurrency was the infrastructure. I didn't realize it was the alternative. That difference in perspective was everything. For Dmitry, crypto was a response to system failure. For Alina, crypto was the system. He asked her, "What do you think happens next? 5 years? 10 years? Alina thought carefully. I think what Russia built becomes standard, not because countries want to evade sanctions, because the infrastructure works better. Faster settlements, lower counterparty risk, no political access control. Why would any country want to depend entirely on a system that can be weaponized? Dmitry had reached the same conclusion. So Bitcoin becomes a reserve asset? It already is. Russia's holding it. China's accumulating quietly. Gulf states are positioning. The game theory forces everyone to follow. If you don't hold it and the price goes up, you've lost relative wealth. If you do hold it, you're diversified against dollar risk. She paused. The US will have to accumulate eventually. They'll resist as long as possible. But the math is inevitable. Dmitry asked the question that had been bothering him. Did we just get lucky? What if Bitcoin had failed? What if it crashed to zero during our adoption? Alina shook her head. It wasn't luck. Bitcoin succeeded because it solved a real problem. We needed payments infrastructure that couldn't be sanctioned. Bitcoin provided that. If Bitcoin had failed, something else would have emerged. The need existed. The solution filled the need. She was right. The $300 billion freeze had created overwhelming demand for unfreezable reserves. Bitcoin happened to be available when that demand materialized. But if Bitcoin hadn't existed, the market would have created something similar. Dmitry thought about his own holdings. He'd bought Bitcoin at $54,000. Now it was trading at $130,000. His original investment had more than doubled, but he hadn't sold. Not because he was speculating on further gains, because he'd learned what Bitcoin actually was. The only reserve asset he controlled completely. No bank could freeze it. No government could seize it without the keys. No sanctions could block it. He'd spent 40 years trusting the international financial system. That trust had been destroyed in 72 hours in March 2022. Bitcoin wasn't about getting rich. It was about never being vulnerable again. Alina asked, "Are you keeping your personal holdings?" Dmitry nodded. "Until I die. Then my kids inherit the keys." She smiled. "Smart. My generation assumes we'll retire on Bitcoin. Your generation got forced into it, but the result is the same." They spent the rest of the meeting discussing operational details, security protocols, regulatory compliance, exchange relationships, contingency plans for various scenarios. Before Alina left, Dmitry gave her one final piece of advice. "The system I grew up in was stable for 70 years. Then it changed in a weekend. Never assume stability is permanent. Build redundancy. Maintain optionality. And never ever trust a system that can be weaponized against you." Alina understood. Her generation had learned that lesson by watching his generation experience it. That evening, Dmitry sat in his home office. He pulled up his Bitcoin wallet. 1.8 Bitcoin now, worth about $230,000. He'd started with 1 Bitcoin. The rest was accumulation. Small purchases over 4 years. Not speculation, just consistent allocation of a portion of his income into the only asset he knew could not be frozen. He thought about the journey. March 2022. Panic. His entire payment infrastructure collapsed. 300 billion in Russian reserves frozen. No way to pay suppliers. No way to receive payment from customers. Desperation. August 2022. Skeptical experimentation. First crypto transaction. Terrifying, expensive, but functional. 2023 through 2025. Scaling, learning, building relationships with exchanges, training staff, developing security protocols, growing from experimental to operational. 2026. Normal. Crypto wasn't alternative infrastructure anymore. It was just infrastructure. And across Asia, the Middle East, and increasingly Latin America and Africa, the same pattern was repeating. Dmitry pulled up a chart showing global cryptocurrency transaction volume. The curve was exponential, not from speculation, from adoption, from real-world use in international payments. Another chart, estimated Bitcoin holdings by nation-states, growing monthly across multiple countries. A third chart, percentage of international trade settled through non-dollar mechanisms, up from 12% in 2021 to over 30% in 2026. Much of that increase was crypto-enabled. The system was changing, not because everyone loved Bitcoin, because the old system had weaponized itself and the market created an alternative. Dmitry closed his laptop. Tomorrow he'd officially hand over operations to Alina. She'd run the company through the next phase, the phase where cryptocurrency wasn't novel, just normal. He'd spent 4 years building infrastructure that shouldn't have needed to exist. But it did exist now, and it wasn't going away. Now, here's why Dmitry's story matters to you. It's a fictional character, yes, but every detail, the frozen reserves, the legislation, the transaction volumes, the government statements, all of that is documented fact. Right now, across Asia, the Middle East, Africa, and Latin America, there are thousands of executives like Dmitry, trade finance officers, treasury managers, CFOs, all facing the same realization. The international financial system they trusted can be weaponized. Most won't admit it publicly. Central banks don't announce they're diversifying away from dollars because of freeze risk. That would be diplomatically awkward. But their actions speak clearly. Treasury holdings are declining, gold reserves are increasing, and quietly, systematically, Bitcoin infrastructure is being built. $300 billion frozen overnight. That's how much Russian central bank assets were locked by Western sanctions in March 2022. Not seized, not destroyed, just inaccessible. Like having your bank account frozen, except the bank account belongs to an entire country, and the amount is larger than the GDP of Finland. These weren't Bitcoin sitting in some wallet that could be moved with a password. These were government bonds, treasury securities, reserves held in dollars, euros, pounds, the safest assets in the world, according to every economics textbook written in the last 70 years. The foundation of international finance, the backbone of global trade. Except on March 2nd, 2022, they stopped being safe. They became leverage. This wasn't just the largest financial weapon ever deployed in human history. It was a fracture in the system itself, a signal that the rules everyone thought were permanent could change in a weekend. But systems don't abandon beliefs overnight. People do. And to understand why Russia built an entire cryptocurrency payments infrastructure in response to those sanctions, we need to understand what those frozen assets meant to the people who watched it happen in real time. To illustrate this, let me tell you a story. Obviously a fictional one, but bear with me, because it's built from documented events, real transactions, and verified policy developments that happened across hundreds of Russian companies. Picture this guy, Dmitry Volkov, 52 years old, CEO of a mid-sized Russian trading company that moves industrial equipment and raw materials between Russia, China, India, and the Middle East. Before that, he spent 18 years at Gazprom Bank, running international settlements. His job was simple: make sure payments cleared, dollars out, rubles in, euros to suppliers, yuan from customers. For nearly 2 decades, his entire career was built on one fundamental belief: the international banking system works. You send a SWIFT message, the money moves. You hold dollars in correspondent banks, they're accessible. You trust the infrastructure because everyone trusts the infrastructure. It's not exciting work. Nobody makes movies about trade finance officers, but it's essential. Without people like this, global commerce stops. Ships don't leave port, factories don't receive materials, supply chains collapse. The morning routine was mechanical. 7 a.m., log into banking portals, check overnight clearing, confirm that yesterday's invoices had settled, review today's outgoing wires. By 8 a.m., 15 to 20 transactions cleared, moving anywhere from $50,000 to $5 million depending on the contracts. Coffee at the desk, black, no sugar. Quick call with logistics about a delayed shipment from Novosibirsk. Another call with a Chinese counterparty about payment terms for a steel order. Lunch was usually something delivered while working through compliance documents. The system was boring, predictable, reliable, which is exactly what you want when you're moving hundreds of millions of dollars a year. Dmitry had no interest in cryptocurrency. Bitcoin was something he'd heard about, obviously. Some younger colleagues talked about it. He thought it was speculative nonsense, volatile, unregulated. Why would anyone use digital tokens when you had a perfectly functional system of correspondent banking, SWIFT networks, and dollar settlements that had worked flawlessly since the Bretton Woods era? He didn't need innovation. He needed reliability. Then February 24th, 2022 happened. Russia invaded Ukraine, and Dmitry's perfectly reliable system started cracking. First, it was small things. A payment to a German supplier took an extra day. A British bank requested additional documentation for a routine transfer. Normal friction, he thought. Geopolitical tensions always add paperwork. Then came the call that changed everything. Before we continue with Dmitry's story, do me a quick favor. Hit that subscribe button right now. This is going to be a deep dive into how Bitcoin went from internet money to geopolitical infrastructure, and you'll want to follow this channel for more content like this. And here's the thing. I want to know what you think about Bitcoin. Drop a comment right now, just one word. Bullish if you think Bitcoin becomes a global reserve asset, or bearish if you think this whole thing collapses. I'm genuinely curious what this audience thinks. Comment bullish or bearish right now before we get back to Dimitri's story. All right, back to March 2022. Dimitri was reviewing contracts when his phone rang. It was the CFO. Turn on the news. He pulled up Reuters on his second monitor. The headline was simple but devastating. Western allies freeze Russian central bank assets. $300 billion gone, not seized, not stolen, just locked, inaccessible. This is documented fact. Confirmed by Reuters, the European Union, the US Treasury, the largest asset freeze in financial history. Dimitri's first thought wasn't about the central bank. It was about his company's dollar accounts. He opened the banking portal. The balance showed normally. Money they needed to pay suppliers in China next week. Money that technically was still there, but was it accessible? He tried to initiate a test transfer. Transaction pending review. He called the bank. 45 minutes on hold. When someone finally answered, the message was corporate and careful. We're reviewing all Russian counterparty relationships in light of recent sanctions developments. Translation: your money is frozen, not officially, not legally, just frozen.